And joining us now to break down key stocks in the energy sector is David Burrows, Chairman and Chief Investment Officer at Barometer Capital Markets. And David, thanks very much for joining us.
Happy to be here.
All right. It's been an interesting start to the year with the energy sector. What are we looking at? How is it done so far? And what are we looking at as we head further into 2026?
Look, it's really a continuation from what started in 2025. We had strong metals markets early in 25 and precious metals. It rotated into base metals. And as it goes with commodities, at some point you get energy to join the rally. And while crude prices are still, pretty low and not near highs, we've got many of the large cap energy producers performing really well, making new highs, and ultimately, getting some multiple expansion, especially those with long life assets, as it's becoming clearer that a lot of the shale oil producers in the U.S. are in decline and really are probably beyond their best days.
Now, we have seen a kind of a bit of a mini rally, I guess, for oil. Is that all the geopolitical, or are there other reasons for it?
Yeah, look, I think there's lots of cross currents in oil, but the energy sector became very, very underowned. Many investors were short oil, expecting a glut, which has not really appeared. As a result, a lot of people stayed away from the big cap energy stocks. But you don't have to look any further than the biggest to understand that something's going on there. And the fact is, these are huge cash generators. When in a world where we have persistent inflation, dividend growers by nature are the hedge, a rising stream of income against a rising cost of living. And some people don't think about it, but some of the very large commodities producers are big cash generators and will be prolific dividend growers going forward.
And is there any particular ones you're looking at?
Well, look, I think that for those that are focused in this space, there are lots of intermediate sized companies that are interesting. I think really you don't need to go further than the largest of the large caps, CNQ, Imperial Oil, Suncor, chugging along, ExxonMobil in the US. These are going to be great total return. But when you think about it, all of them have gone through paying down debt. They all are generating a lot of cash. They're all a little different. CNQ a little bit more focused on growth. But I think that Imperial Oil is a great example. If you look at what happened to Imperial in the last energy bull market, multiples doubled, dividends doubled, cash flows doubled. And you can do the math on that. It means the stocks went up a lot. And we are probably a year into what will be a very long-term bull market in this sector.
And of course, AI is what everybody's talking about, but you're cautious on the big cap tech.
Yeah, so we come at things from a macro perspective, and every asset class and sector and theme has its day in the sun. Realistically, as international stocks underperformed for a decade, and the U.S. really was the market to provide returns, international investors became very, very concentrated in the U.S., in particular in secular growth stocks. But the market has broadened. There are alternatives. International local markets, almost every one of them is outperforming the U.S. stock market today. U.S. dollar is weakening versus every major currency in the world, including the Canadian dollar. And so you have to assume that from a maximum long exposure, international investors might be interested in taking some money back to their local market, benefiting from their own strengthening currency. The sector makeups in international markets really favor them right now because they're heavy in financials and industrials and materials and energy. So we think that there's a good opportunity there. And so when we look at large cap tech, they've gone from being big cash generators to starting to burn cash. And the multiples are contracting, not expanding. And when you look at the results that they reported in the most recent quarter, is reminiscent to me of the early 2000s, where companies beat estimates and got creamed the next day. It just tells you the next marginal dollar of demand for those shares is not there right now. It's rotating to somewhere that will treat it better.
All right, let's get in. You mentioned Imperial Oil, a couple of other stocks you're liking. Caterpillar is one of them.
Yeah, we are very focused in industrials as a firm. I think we're probably 16-17% focused in industrials, and spent a lot of time talking with them over the last couple of years. Caterpillar is one that we've used as a top pick on BNN. We own Caterpillar, we own Finning Equipment, we own Toromont. These companies will be big beneficiaries of the capital raises that have been done in basic materials companies. There's going to be a lot of mines built, and there's a lot of infrastructure being built around power. And Caterpillar sits at the middle of all of that. Oh. So again, earnings should grow, multiples should expand, and well suited in a world where there's an industrial renaissance going on.
Okay, we have to wrap it up there, but David, thank you as always for joining us.
Thanks for having me.
David Burrows, Chairman and Chief Investment Officer at Barometer Capital Markets.